going here, so give me a minute or two and
Okay.
going.
Hey, Bobby.
Hi, everybody.
Hi,
Hey,
how are
Bobby.
you?
Hey.
Okay. Okay. Got it.
Okay, we are live. So we do have 5 whenever the trustees want to get started, the co-chairs want to get started.
All right, this is investment committee meeting on today, which is November 15th, 2023. And I'm calling it
December
15th, and I'm calling it to order. Can I get a roll call vote, please?
Angela
I think, right?
Bates.
Yeah.
Yeah. Christina Bennett. Lewis Cross.
Present.
Sheila Goodwin. Donna Jones. Yvette Levy. Martel Mann.
Here.
Bobby Richardson.
Present.
Albert Sanders.
Present.
Justin Stein. Doris Walker.
present.
All right, so we do have 5. We have a quorum. I guess Jeff and Gwelda, what your pleasure is, we're to get started.
Well, good. Do we want to go ahead and start with the pacing study? Sue, if you
Yeah.
want to pull that up.
Okay.
And I'll apologize to everyone in advance. Hopefully everyone can hear me okay. I'm sitting in a noisy airport. So if anybody doesn't hear something or here's an announcement for a flight over me talking and misses something, let me know. So I'll try to project as best as I can. So happy holidays to everybody. Good to see everyone. And so I know in the past you've seen pacing studies from NEPC. So and we've gone through those as well historically to make sure what we're sort of looking at is a follow-on, or at least sort of make sense of what NEPC has done in the past for your privates portfolio. So I would tell you ours is going to be a lot more, I'd say, high level, to the point, and I think some of the additional detail that's probably just going to be very far in the weeds, we try to leave out. So we try to keep this as summary as possible. So Sue, if you want to flip forward to the first page. There we go. So how we have this broken down is into 3 different sections, one that covers private equity, one that covers private debt, and then one that covers real estate. But the objective is all the same on this. And so just to give a little bit of background again for the private equity, for all the private portfolios, again, we all have to remember that these investments operate a lot differently from a large cap manager or an index fund manager, where those are very liquid. And if we want to make a change in those portfolios, we can do it in a day. So we can terminate a manager and liquidate the positions and move it to a different manager. All the privates operate a lot differently in that, number one, they're slow to take capital. So if we tell them we want to give them $12 million, they might not take it all at once, because the deals that they're looking to get done might not come up. So there's a process for how long it takes them to call capital. And conversely, on the other end, the money doesn't come out quick. We can't go to a private equity manager and say, hey, we want you to give us $5 million back because we need it. That it doesn't work that way. The only way we get money back is once they go out and liquidate one of their deals that they're working on, they slowly give us that capital back in distribution. So all of these things take a lot of time. And where this presents challenges is that for each of these different asset classes, we have policies. So we have, for private equity, we have a 7% target level, and that's of the total system assets that we want to be at. And so we have a little bit more of a challenge of a lot of these private equity funds, they're not always in the market. And so there's a process that we have to time to find an appropriate manager and start giving them commitments. Then there's a period of time that it takes them to call the capital. And then we have to think about the other managers that are currently in the portfolio and that they're not giving all of our money back at certain periods of time. It's sort of uncertain. So that's why we create these types of models to say, if we make some estimates and say, how much do we expect our current managers might be giving us back each year, and how much do we currently have, and then what do we need to be at for a target, that can kind of give us some estimates of how many new managers or additional fundings we need to make over the next several years. So that's really what this type of study tries to encapsulate. So maybe we can start with the top chart at the right and just talk about some of the lines that we see here. So the one is going to be the target allocation, and that's the red line with the triangles. And so if we project what we think the total system's assets will be from now between 2032, and then multiply that by the 7%, that gives us a dollar target of where we need to be in compliance with the policy. The next line, the one with the squares, that's the projected allocation. So that, according to our model, if we make commitments according to how we've estimated in our model, that's the line that sort of gets us there. And so the objective is we want that line with the squares to be as close to the line with the triangles as possible over time, and try to manage that line to make sure they're in check. And now the dotted line, that's currently the allocations that you have on a market value basis. And so why does that one have sort of that hump? Well, because if we did nothing, we didn't make any new commitments and just sat on the ones that we have today, the managers would draw a little bit more capital. And so you see that line goes up and then it sort of peaks, and then they stop calling capital, and then they start giving us distributions back, and then it tapers off. So that's sort of the gap we're trying to fill, is that we have current managers, but they're going to stop calling capital at some point. They're going to start giving us capital back, and we need to fill out that gap to get us in check with that triangle line that we see on top. So that's sort of the objective. And there's a lot of assumptions that go into these. In particular, we don't always know the timing of when a new manager or one of our current managers is going to call additional capital. We can get estimates, and they can tell us estimates. And we also certainly don't know the timing of when they're going to give us money back. So again, we can talk to managers, we can get an estimate of that. And so there's definitely a lot of estimation that goes into these types of models. And so, one thing that you will see if you look at the line that has the squares, that's the projected, that at a certain point in time, we sort of go over the policy target. And that's sort of a concept we call of over committing. And sometimes that's fairly standard to do, because again, that kind of helps us even out. If we overcommit and then other managers are giving us money back too quick, and then we can make contributions that are sort of above the level of the policy, that they can kind of even out, and we end up sort of being right on that policy line. But again, part of that too is when we created the investment policy statement that we just updated, that we have ranges that account for that as well, that account for the fact that we might not always be perfect in our timing. So we can be underweight an asset class by a certain amount, and we can be overweight the asset class by a certain amount. So we look to accommodate that in the investment policy. So That's the general gist, and that's going to work the same for all of the asset classes. However, the answers that we're coming to here are going to differ by asset class. So let's sort of start here with private equity. And again, you can see the objective of what we're trying to do to stay on the policy, but there's a bottom line to this study, and it says, okay, if we're pretty close on all of our assumptions of what our current managers are going to continue to call and distribute, what do we need to do to stay in compliance with policy over the next several years? So that's where the rubber meets the road on that chart to the bottom right. So those are the dollar values. So if we want to attempt to stay in compliance with policy, next year we'll need to commit $12 million. The year after that, we'll need to commit $7.5 million, and so on and so forth as we go down to 2032. Now, why do we do these studies every year? Because these can change a lot. So if we have a year where these distributions don't come in as expected, or a new manager that we fund doesn't call capital the way that we expected, this is always a moving target. So that's why we want to do these fairly frequently, so we can always reassess what we need to do, but we can always at least get a good picture of what we need to do the next year. So this is sort of where we're at now in $12 million. And so if we look at what we've done, or the system has done for the past couple of years as far as funding managers, they've sort of been in that 10 to $12 million range. So from that perspective, if we're looking to commit at a similar level and similar allocation per manager in that portfolio, that 12 million would translate into one manager. So our objective here is that we would bring to the committee in 2023 one private equity manager. And so we've been in well to jump in and add any additional detail on this as you see. But again, we've talked with our research group and all of our asset classes, and have gone through this pacing study with them. And again, this was done with our research group's help as well. But just to
Hey,
say,
Jeff.
oh yeah, go ahead.
So you say 12 million, but we have historically maybe on the high end of given 12 or so, but we've usually looked at, complementary managers in the same asset class or private equity, or filled in the gaps. So some of our managers may have a $5 to $8 million, and then some may have, but we always like to look at multiple managers when we come in to do a search, and then dwindle it down based on your recommendation. Is that what you're foreseeing?
We can certainly go about that. I guess the major caveat on that we would give you right now is that again, just from the pipeline that our research group has, we don't have a bunch of them. So I think that's one sort of limiting factor. And then a second limiting factor too, and we've made it very, very clear to our research team that the MWDBE mandate is very important. So trying to, and again, we've sort of given research to that mandate of saying that's very important for the system. And so any new pipeline and deals that we're looking for in the future, really, we want to fit that bill. So those are sort of the limiting factors. But again, in any given year, if we have multiple managers that we can bring to the table, well, we can certainly bring multiples. But I just think in any given year, depending on what the pipeline is and deal flow, we might only be coming to you with one that makes sense. And again, part of that process too is that Gwelda and I and our research team are also looking at the current portfolio and saying, we want to make sure we're diversifying. We want to make sure that if there's a gap or something that's different, we want to make sure we fill the gaps. And I know one thing that for sure is we know there's been quite a bit of fund to funds or double layered fee type exposure that we have in the portfolio. And so one thing that we've thought about here, and we're certainly we probably want to prioritize in what we look to do in private equity and private debt and elsewhere is that we're looking for more direct exposure as opposed to fund to funds exposure.
I agree with you on that aspect.
And actually, Christina, we sat down and had a call, well, actually had a meeting with our private equity and private debt analysts as well as real estate. And number one, there's a couple of things going here. The availability, as Jeff was saying, of what's coming to market, and then the timing of it. And we do understand that your timing is of such that even if you approve it in your committee, we're looking at probably a good 60 days to make sure everything is in place, paperwork and through the board. So we're also looking at that, trying to factor that in, as well as MWDBE mandate. So therefore the list gets smaller and smaller, and we want to make sure we're doing compliments, as Jeff said, to what you currently have, instead of just having a bunch of different names in there. If we have something that's coming back up that makes sense to add to, then we'll go with that, especially and make sure that we don't have concentration in any one manager, but we may come to you with only a recommendation for one rather than two.
Okay, and then, I mean, so what are our gaps right now?
I need to go back to my notes with the, but what they did say is we've got a lot of secondaries, and we're trying to get you to a place where you're not paying as heavy of fees. But I would have to look at I'll look at the structure of it, and I can get back to you at the next meeting.
Yeah,
Okay,
I mean,
that's good.
yeah, from a high level, Christina, it is, I mean, the gaps are going to be, as opposed to multi-manager fund to funds exposure with the multi-layers of fees to go more direct. Number one, there is quite a bit of secondaries exposure, so to potentially look at some primary deals as well. So those are, I think those would be the two focus areas at this point.
But what sector?
That's what I'm saying. We need to.
Okay.
Trying to see if I have my notes, but we can get back to you at the next meeting. But we just wanted to basically at this meeting just tell you what the pacing model has said as far as what is committed, and then we'll come back at the next meeting more detail as to where we're looking, and also we have a schedule that we're looking at putting together for you all for when you might be looking at these managers next year.
And Christina, that will also be part of the process for the next meetings that we bring either recommendations, but there's going to be education to go along with that as well. And we've invited our research group to be part of that, where they'll address that exact question of, number one, from a structural standpoint, fund to funds versus secondaries versus direct, and also just to talk about where there are sector exposures and other issues and how we best diversify. So that'll all be part of that process.
Okay, thanks.
Okay, so with that said, unless there's other questions on private equity, again, I don't think we want to get too far ahead of saying, hey, here's what we need to do in 24, 25, 26, because that's really a moving target. But I think at the very least, I think we have a pretty good idea that we're going to want to think about that $12 million for the number for 2024. And again, how we split that up is something we still need to reconfigure and think about from our end, but we'll definitely be in a good position in the first part of next year with a plan on that, whether it's a single manager, multiple managers, and again, what sectors and stages they're all going to be in. Okay, Sue, do you want to flip forward one page? Okay, so this is going to be from a procedural standpoint, very, very similar, and this is for private debt. And again, the top chart on the right, you can see, so we have a 5% target, and again, the lines that you see all work the same. So the line with the square, that's projected, that's really where we want to get to, or how we're planning to get to where we want to get, which is the lines with the triangles. That's the target allocation of 5% based on expected system assets through 2032. The dotted line, again, those are the current managers and what we expect will happen with them from a distribution standpoint over time. And so again, the table will tell us how we would fit sort of fit the gap here. So you can see from a couple reasons, because from the current target we were sort of in line, but then recall when we did the portfolio asset allocation structure review that we had recommended and we had approved a 5% target for private debt. So that lifts the target a bit and means we have more of a gap to fill here. So you can see what that number translates to in the table on the bottom for 2023 to the tune of 21 million. So now putting that into the perspective of, again, thinking about what the past fundings in private debt have been on a dollar basis, that funding would be in the form of multiple managers. So at least two, and depending on, again, the opportunity set and pipeline and what we see, possibly an additional manager there to make that up. So, and again, one thing that we'll talk about, whether it's private equity or private debt, is there may be opportunities with current managers to do follow-ons. In private equity, we haven't heard too much. In private debt, and again, this sort of goes back to where there might be gaps in the portfolio. So our private debt group has identified that the distressed area is one area where this portfolio does have a gap and a need, and so that's going to be a priority. There is one manager that they have identified. In addition, Brightwood is out with raising capital for another fund, so there's a potential follow-on opportunity there. So a couple things that we have to evaluate, but there are a couple issues that we're digging a little further into with respect to Brightwood before we think about that. And just one is that they're currently the largest by market value allocation in the private debt portfolio. So to whatever extent we might do a follow-on, we have to think about the right amount so that manager doesn't become too concentrated. There's also just an organizational issue that happened there. There was a split between a couple of the key owners within that firm. And so that's just something from an organizational standpoint that we all have to get comfortable with to say, is this a group we want to do the next round with? So a couple of things to think about there. And then outside of that, again, we've sort of gone through with our research group in debt and said, let's find the priorities. Again, let's make sure that MWDBE is a very high priority for these mandates, and just let us know what's in the pipeline. So they're currently reviewing that. But again, similar situation that we want to be prepared fairly early next year to start those conversations of, okay, here's what we have in the pipeline, having our research group on the debt side come in, again, doing the education, walking through the different structures, strategies where we might have the biggest gaps in the portfolio, walk through that process, and then we can come up with recommendations on here's the managers we think we want to fund in 2023.
Just to go back on that one question you asked, Christina, I did find my notes, and one of the areas that we identified in private equity where you have really no exposures in the global area. So that's one of the areas they wanted to possibly bring forth a manager that has some global exposure.
Sounds good.
Okay, so any other questions on private debt? So again, the number that we're looking at right now is about $21 million, and expectation is that that will be through multiple managers, of which we've identified at least one, a potential follow-on, and then we have our research group sort of has their marching orders to see what else might also fit the bill.
So when do, like, just looking at the study, right? Cash flow, that would be 20 to 22, or maybe even, let's say 30 million in restricted separate accounts for 2023 that are held 5 to 7 years before we, maybe potentially start seeing a return. What does that do to our cash flow and our funding?
Yeah, I mean, and again, I would tell you from the standpoint of if you just look at the target allocations that we have recommended between, at private equity at 7%, private debt at 5%, and then we can talk about the real estate as well, that all of those targets we've thought about in the form of cash flow and making sure that we have the ability to provide cash flow for benefit payments and expenses on a go-forward basis from the liquid parts of the portfolio without creating any major issues on having to rebalance, at least around the private. So again, our initial targets that we've recommended for the asset class, do take that into account. And, certainly again, when we think about pacing, we also think about that as well. So, and again, from the standpoint of how, if you look at the target allocations and then relative to, so if you look at that, the line with the triangles, that's the dollar amount times the percentage times what the estimated system assets are. So if you look at our assumptions to the left, what we assumed was a 2% annual growth rate. So that basically said, if we estimate that we're going to get a 7% return on assets, and then we have cash outflows to the tune of about the 5%, that we're still growing at a net rate of 2%. So all of this takes into account that we do have that net cash outflow in the plan.
Okay, that makes sense.
Yeah, and also, Christina, remember that you've got quite a few secondaries which pay back in much faster too.
True. True. I appreciate it.
Okay,
Hey,
why don't we-
I had a question.
Sure.
Okay, well, I'm looking at the chart for 2023. You asking for 21 million, but as the year goes on, you go down. Why is it so high, 21, and next year is 16?
Yeah, so again, a lot of that, well, the 2020 is a little bit easier because it's shorter term. We have a better understanding for one year forward of, we know what we currently have allocated, which is about 3.5% of the total system assets. We know we want to get to 5. And so that's a level that we think if we fund 21 million and those managers call capital at a fairly consistent rate for the next couple of years, that gives us a good shot of getting towards our target and sort of offsetting what the current managers are giving us. As you go forward, those numbers might look a little different and probably rely a lot more on assumptions, because we're saying, well, 2-3 years out, we have to think about how much money our current managers are giving us back. So we're making an assumption, and then how much the new one, so the $21 million worth of managers that we fund next year, are they calling a good portion of that $21 million? If they are, that gets us closer to our target sooner. So, and lets us not have to fund as much in the following years. So it's a little bit, I guess, more present value heavy, in that we kind of know where we need to get, and we want to get there sooner rather than later. So let's sort of, I don't want to call it overfunding, because we really don't get overcommitted until you see like 5 or 6 years out. But this kind of gets us to the level where we can start to get committed and overcommitted to the level that gets us towards policy.
And
So
also,
I don't know if that helps, or that's
Yeah.
and we're kind of playing catch up as well, Ms. Richardson. It looks like we had a gap of about 4 or 5 years where there were no commitments made.
Okay, thank you.
Sure.
Right, and again, I think the important thing to point out too is that the target did change. So we used to be at a 3% target. We've increased that to 5%. So that has sort of changed what we would need to do immediately to get us closer to that new higher target.
Okay, so if we were asking for a 7%, we ask more than 21 million there.
Right.
Okay, I got you.
So Bobby, go back to the reports that we used to get, that we used to talk about with Kristen, that said about what she used to refer to as vintage years.
Yes.
And so when we, and remember she used to say, you want to allocate every year, your vintage year, because it's going to take anywhere from, 3 to 4 years before they start investing, pulling the money down and giving us some type of return. So we missed a couple of those years. And we didn't really do anything in 2022 because remember in 2021, we were trying to catch up. And we did about, I don't know, 40 million in some allocations around, I want to say October, November of 2021, just to try to catch up because we were laxed on some of our vintage years. And so the goal was to get a vintage year every year so that as you're putting some on as some are falling off, so that you're getting a return from those older vintage years.
Okay, thank you. Okay.
And we did have a few that were approved by the trustees in 21 that did roll over. They didn't close till 22. So I think we have just a couple that were a vintage 22.
Okay, thank you.
Okay, well, good. Why don't we flip forward to the real estate section? So, and this one's a little bit easier because just given the not only the current amounts that we have with UBS, but also recall that towards the end of last year, NEPC had recommended a number of real estate managers that are have been partially funded and are going to continue to be funded, and that's sort of according to our pacing model says we're good relative to our target. So that's why you see all the way out through 2032 a lot of zeros. So and now we also have to throw into the mix that we do have that redemption in for UBS. So and again, sorry about that loud announcement in the background. So the UBS redemption is going to certainly be something that's an uncertainty within this type of model, which is why we're going to want to continue to address it pretty closely on an annual basis. Because if we were to get a lot of the UBS money back soon, within the next couple of years, this picture might change to the extent where maybe we do need to start thinking about new allocations. But again, just based on our discussions with UBS and our estimation of that portfolio and liquidation process, that is probably going to be a several year process before we start to get a meaningful amount of that money back. So for all intent and purposes, just based on how this has been modeled, we really don't have any work to do with respect to looking for new real estate commitments over the next certainly next year and potentially for the next couple of years. Any questions on real estate? Okay, and if not, that's really all we had to cover on the pacing model. And again, this is the last page. This is just a summary of what has happened in real estate. And again, you can see where the two biggest allocations are down at the bottom. Those are the two UBS funds. So on a market value basis, all the way over to the right, 37 million for the Trumbull Fund, 20 million for the Trumbull Property Fund. And then you can see those more recent commitments are all of the funds up at the top. So Aledade, where 5.5 million was committed. BIG Fund 1, that goes back a few years. That's back to 2018. 8 million when they've drawn a good portion already on that. BIG Fund 2, that was the most recent at $8 million, and then Elm Tree again back in 2021, so a 5 million. So between that BIG Fund 2 and the Elm Tree, might see a little bit more called, but I think that most certainly BIG Fund 2 is where you would expect to see the most being called for the next year or so within that private real estate category. But again, the real big allocations here and what really is going to drive this model for us for the next couple of years will be those UBS allocations, and in particular Trumbull, where we have a redemption pending.
Yeah, and out of the ones he's showing here, actually, they have a vintage year of 2021, but they were actually funded in 2022 once we came on board. Aladage, Big Fund 2, Elm Tree, Kane Anderson, because we had to write opinions on all of those.
I really
good.
like
So
this report. Thank you.
Great. Hopefully everybody found it helpful, and hopefully it's digestible. But boy, we think it makes it really simple to say this is something we need to be looking at consistently on an annual basis, just to make sure we are in compliance with our policy and that we're actively out there seeking and recommending investments when to keep us in compliance. So maybe with that, since we just talked about real estate and UBS, I'll just transition for a few moments over to UBS. And so I don't know if you had anything to pull up on that. Probably not, but.
Well, I've got that one sheet. Do you want that one?
Oh,
yeah.
If you do have that, it's the scenario.
Yes.
Yeah, if you could pull that up, that would be great.
I will.
So while Sue's pulling that up, I'll just let everybody know. So after we let UBS know that we would be putting in a full redemption for the property fund, they came back to us, as they've come back to all their investors, and said, well, we know this liquidation is going to take a long time because they have a significant amount of redemptions, to help them sort of manage the process and to be to let them have some predictability of when capital can come out of the fund. They said, well, if you can commit a certain portion of your money for the next 3 or 4 years, you can still have your full redemption, but if we know we have 3 or 4 years to pay it out, we'll give you a break on fees. And so the deal they gave us was if any amount that we would commit for a 3-year period would get a 15% discount. Any amount that would be committed for a 4-year period would get a 25% discount. So as we talked with them and really understood what this whole liquidation process is going to be like over the next several years, we basically said it's going to take 4, 5+ years anyways to get all of this money back. So from our standpoint, if we say, yes, we're going to commit a certain portion of the money for 3 to 4 years, we wouldn't be getting that money back anyway. So why would we not just take a fee discount? So that's sort of where this comes into play. And there's a bunch of different scenarios, but really what we would recommend here is the scenario 3, and that's to take 50% of the full redemption, which would be the $18.6 million, and commit it to what they call their 4-year loyalty program. And that just says that in 4 years from now, they'll give us a full redemption. We can go into full redemption for that remaining portion. But again, from our standpoint, we really don't think we're getting that money back in 4 years anyways. So if we were to commit that amount, we would save about $111,000 in fees, just based on that discount. So for the next 3 years, they would work on getting us back the first half of that. So they estimate they can do that. Again, I think we're pretty skeptical even on that portion might take some time to get back, but we do at least want to have the first half of that immediately in the redemption queue. And then systematically how this works is when we get to the 4-year period, we would then be in the redemption queue for the remaining amount. So now from the standpoint of we had to look at this and say, well, do we think we're getting disadvantaged? Is there a first come, first serve queue? Would we go to the back of the line if we did something like that? And the answer is no. So Any dollars that are in the queue today are going to be treated as the same as any dollars that are in the queue 4 years from now. It's all pro rata relative to everybody else that's trying to get their money out of the fund. So really not disadvantaged. It's just really, I think, having a realistic expectation that this is going, it's a large fund. They have a lot of redemptions, and it's going to take a lot of years to get this money back. And so with that said, why not take advantage of a fee discount here? Any thoughts or questions on it? But I guess it doesn't change, again, the whole concept of we still recommend a full redemption from this manager, and we would be ultimately in a queue for a full redemption.
Yeah, I like saving money. And it's a shame that they decided to only drop the basis points when we said we wanted out.
Right.
But I kind of agree with saving $110,000. We can't get out of it any sooner anyways, so why not take the savings? And see where we are. We should have started this 4 years ago, but we didn't. So I would say let's start the timetable and save money while we're at it.
Yeah, and I guess from that standpoint too, Christina, I can tell you that, and why we've estimated that this is going to take quite a while. We've had other clients that have been in this redemption queue for UBS for 4 or 5 years now. So, and that's when the amount of redemptions was even a lot smaller than it is today. So, they have 7 billion now, and I think we've had clients that have been in this redemption pool when that pool was probably about 2 billion, and have not received all of their money back yet. So that shows how long this will take.
Yeah. So do we need? Does anyone else have any comments on this? On these options? So we probably need a recommendation to approve this and then take it to the full board.
Yeah, I mean, we already have the redemption. That's not really going to change. We've got that recommendation. So we'll
Right.
just set that, and we'll just, we can, certainly trustees can do a motion, but this isn't going to change that recommendation that's already been made.
Correct. So are you saying we just accept the recommendation of option 3 and just take it to the full board as an FYI?
Yeah, I think because we've already made that decision. Again, we can, do a motion, but it's not really going to change, that we're already going to start on the redemption for the full queue, which is what we've already voted on.
Okay. Okay, what's next on the agenda, Sue?
What, Jeff and Gueldo, what do you want to do next? Do you want to talk about the global litigation? Do we want to look at the flash report, or what do we want to do? Gueldo, you're on mute.
The global litigation shouldn't take long at all. Sue sent out a memo.
So Guelda, before we start that, did we look at Motley Rice? They've been trying to get in, and is this similar to Motley Rice?
Yeah, Motley, but this is did not look at Motley Rice, but this is global.
Oh,
Not
global.
the-
Okay.
Yeah, this is global class actions.
Okay.
So Sue sent out a memo regarding class action, global class action services. And there were, US Bank had recommended a couple of firms, Broadridge and FRT. Well, FRT came back and said they charge basis points for the service, basically $15,000 annually. All the other global litigation firms, basically it's on only if they don't charge a fee. It's based off of if you utilize them. So the two firms that came back that do the global services are Robin Skeller, Rudman and Dowd, and the other one was BLBG. Now, not that there's anything wrong with the LBG, but as far as familiarity is concerned, Robbins, Geller, Rubin, and Dowd, both Jeff and I have utilized them. They've done a good job. They have proprietary systems. The reporting, is quarterly. They're 100% in-house. They don't outsource any of their data collection, et cetera, et cetera. They're pretty comprehensive analysis when it comes to international claims. So out of those two that do global services, Jeff and I got together and we would recommend that you use Robbins, Geller, Ruddiman, and Dowd, and they basically will work with the custodian bank, collect the information, and provide quarterly reporting on any global litigation. This is something that we're seeing more of going forward, and all firms don't do global. Some of them only do domestic. So that's why we think that you should utilize a global monitoring service as well as your traditional domestic services.
Which is through US Bank, our custodian.
Yeah, through US Bank, yeah.
Okay, and so so their fee is based on what they're able to obtain, or
Yeah.
is it, okay,
Yeah,
so they take a percentage of what we're able to obtain. So
Yeah,
really, it's no out of pocket for us. This is just, hey, if you can go find us money, go find it. If you take a fee, take a fee. What percentage is their fee?
I think standard is probably 33 1/3 on the
Yeah.
settlement, but again, that can vary. I think what's also important to point out too, with respect to the global, because we did spend some time with these groups on this, is that the global settlements work a little bit differently. There's a different process for them to get involved in these suits and to get class actions together. And so they did, all of these groups did sort of convey to us up front that potentially if we do get involved in a non-US suit, that there may be a cost at some point, either from a legal standpoint to the plan. And if there is, they would come to us and say, okay, we can go after this suit, but it might cost you X amount of dollars out of pocket. So we would at least have an estimate from them of what that might cost. So we could always bring that to the board and say, okay, there's a suit out there, you can go after it, here's what you might get, but there might be an outlay for it. That doesn't happen in the US. It's a little bit different. It is all contingency, but they did tell us, at least from a non-US standpoint, that some of these do potentially have a cost to them.
It could potentially take a little bit longer too than your domestic litigation suits.
Right, but they're not going after a case if they don't feel they confident that they're going to recoup something.
Yeah, just like, you know, and you know, it pretty much operates similar that the traditional ones that you've seen before.
Mm-hmm.
Yeah. Or domestic ones, I should say. They go for domestic litigation suits.
Okay. So we would need a recommendation from the investment committee to, for
Yeah,
this. Do you have a,
yes, I'll pull up. So it's that
Okay.
first one there.
okay, so, is anyone on this committee would like to make that motion?
Since you've just been reappointed, Christina, I think this would be a good time for you to start strutting your stuff.
I don't, Sue didn't put the name in here, but,
It's Robbins, Geller, Rudman, and Dowd.
I make a motion to select Robbins, Gelman, et cetera, to be hired for portfolio monitoring and global class action services for the retirement system. Is there a second?
I second.
It's been properly moved in second. Are there any discussion? Hearing none, roll call vote.
Christina Bennett,
Yes.
Louis Cross,
Yes,
Sheila Goodwin. Okay, I see you, Sheila. Donna Jones,
Yes.
Martel Mann,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
and Doris Walker.
Yes.
All right, so we do have 7, the motion carries. So we'll bring this to the full board then on Monday. This
Okay.
recommendation.
Okay. I think the next thing on the agenda is, unless there is some more discussion on that, is the flash report.
Who's doing it today? Up or
I'm-
down, Gwilda?
I'm doing it today. It's another
we
good
play-
month.
Oh, no Jaws music today?
No. Okay,
We get the happy dance music. We'll put
Okay,
that on.
all right. Don't worry, be happy. Okay.
okay, you can move forward in this one, Sue. Okay, as you can see here, and if you guys can see here, as you can see for the month of November, the numbers actually were nicely positive. In November, as in October, we saw positive returns in the equity markets. One of the areas that had been struggling was emerging markets. You can see that at the bottom on that top where it says equities MSCI EM. As you can see for the month of November, rebounded nicely at 14.83%, followed by the MSCI EFA, which is developed international, 11.26, and domestically, the Russell 1000 value led as far as style and size in the domestic markets. On a 3-month basis, you can see the 2 areas that are still struggling is the Russell 1000 growth slightly negative for the 3-month period, and EM had really tough time in the 3-month, just that the most recent performance has actually brought that up. So it's still negative 1.78. But unfortunately, year to date, as you can see here for domestic equity markets as well as international, you've got double-digit negative numbers with the exception of the Russell 1000 value, which held up the best in these very difficult markets. When you look down a little below that, you're looking at fixed income. Look at broad fixed income in the U.S. at a return of 3.68. The corporate investment grade actually had a very nice return in the quarter, the month 5.18, and the global aggregate or your global bonds 4.7. Over a 3-month basis, the only thing that is positive is the corporate high yield at 0.66, but on a year-to-date basis, a tough fixed income market. So we have had a very tough year after coming off of 2021 with very strong returns.
Gwilda, I want to stop and show people here that what our economy is facing. And look at your generic 3-month governments from a year ago, 12/31/21.
Right. Yep.
We were at 3 basis points. And while we understand that there's been quite a few rate hikes for the economy, look at the rate today, right, for a 3-month government. And
Right.
so, I mean, that's where you see the tick. And when, we are is on the negative, the positive is that we're getting, returns here of 4.32 on a 3-month government. And this does relate to our portfolio growth. It does relate to, the pension being stable. And so, while everything else is, looking bad, and I know that year to date looks bad, when we look at that rate on the short-term basis, that's amazing. That looks really good.
That was going to be my next point is that
Oops, sorry.
That's okay. No, it's all right. It's all good. The rates have gone up. So you are getting some returns off of fixed income. Whereas before, they were, like you see last year, they were barely, positive in the 3-month 0.03, which is negligible. So bad on one side, but good on the other. But that's kind of where we are in this market. With that being said, let's move to the next page. And this kind of ties into what Jeff was saying a little earlier. As you can see, all of the areas, the gray bars represent the range between upper and lower limits. And then the little line in the middle is your target. As you can see, with the exception of hedge funds, all of your segments are in line with the target range. And if you can see here in real estate there, you see the little triangle is far to the right, which means that you're over allocated. And that's one of the rationales behind us saying we don't need to commit anymore to real estate in the pacing study that you saw. Now, as far as the market value of the portfolio, we saw an increase to 803,479,089 in the month of November, and that's up from 754,259,181. So we are starting to gain some more ground through the end of November. Moving forward, the return of the fund, total fund was 4.72 in the month of November versus 5.08, slightly off. But you look at the fiscal year, the 1 year, 3 year, 5 year, 10 year, and since inception, you're still above the policy index, which is good. So collectively, your managers over this past fiscal year to date and 1 year period have been able to protect you in a very difficult down market, equity markets markets in the past year. The total domestic equity segment underperformed at 4.88 versus 5.22. If you look down below that, domestic equity wise, Edgar Lomax, who had rebounded really well, was slightly off this month, but the returns going out from there for every time period measured, they've exceeded the Russell 1000 value. Russell 1000 value, as you know, has been one of the strongest segments or portions of the market in the past year. If you look down below that, you've got your two large cap growth managers, Intech and TCW. Intech actually exceeded the Russell 1000 growth in the month of November, and TCW was just in line with. As you can see here, this has been a very difficult time for large cap growth managers, with both of them being negative and below the benchmark in the fiscal year to date in the 1 year number. Moving forward. Next page, you've got the next portion of your domestic equity, which is small, micro cap, mid cap. Westfield, Systematic, and DFA all outperformed in the month of November, rolling up the return as a composite of 3.69 versus 2.34. So that segment of the domestic equity markets actually added value, and that goes across the board for fiscal year to date, 1 year, 3 year, 5 year, 10 year, and since inception, that segment has done very well. In international, you two international managers here, both also exceeded the return of their respective benchmarks with a total segment return of 12.85 versus 11.26. If you go a little bit deeper down and look at your emerging markets managers, DFA had a tougher time. They have been performing very well, but the month of November, it slipped off a little bit with 13.83 versus 14.83. Invesco actually rebounded this month with 17.71 versus 14.83. As you can see here, DFA has held up better in this market time than Invesco. The DFA has a value tilt that explains the returns that they've exhibited in this difficult market. Next page. You look at your global manager, Exponence, manager of managers, actually did well in this month as well, and has done well fiscal year to date in a 1 year number. You see for the month of November, 8.48 versus 6.95. Over the past year, albeit negative on a relative basis, doing better than their benchmark at 9.03 versus negative 10.86. If you delve down further into that actual portfolio, your best performing manager was Arga here, followed by Foresight. A little bit off for Redwood and Martin, but collectively as a group, they've exceeded their benchmark. Next page. Now we go into fixed income. Fixed income as a group, 3.27 versus 3.68, slightly off. If you look down below that, you see both of your traditional core managers, Manulife and Ernest Partners. Ernest Partners, both of them were under the Bloomberg aggregate for the month of November. Exponents actually outperformed at 4.45 versus 3.68. That's more of an opportunistic type of portfolio rather than a traditional core, which we've talked about before. On a 1 year basis, as you can see here, Manulife is off. Ernest Partners has actually held up. Exponents has had a difficult time over the past year. When you look at your absolute return manager, Lumen Sales held up really well in November at 1.58. If you look at a little bit longer term, not so strong. Looking at global, a little bit further down on the page, you got Neuberger and Berman at 4.24, did exceptionally well in the month of November, 4.24 versus 0.53 for the LIBOR. But if you look at the longer term, it has struggled somewhat over the past year. Emerging markets debt, Lazard is the emerging markets debt manager with a return of 5.65, exceeding their benchmark. And they've exceeded the benchmark on a relative basis, fiscal year to date, as well as over the past year and long term, with the exception of since inception. They've actually added value in a difficult market. And I believe the next page is real estate, no, global asset allocation. As you know, we liquidated the GMO portfolio. As you can see, it's now 0. Now you have just left the PIMCO All Asset Fund. Added value in the month of November, 5.56 versus 3.44. And over the fiscal year to date and 1 year, as well as long term, that PIMCO All Asset Fund has delivered. Then down the page, you've got your hedge fund managers. The only manager that delivered a positive return, albeit not quite as strong as their index, was Grosvenor at 0.61, with White Box Interest actually delivering slightly negative returns. The next page, I believe, is all real estate, which we will report on a quarterly basis. But what I would say is we are seeing some of our market value coming back in the month of November. We'll see how the next 2 weeks of the year round out, but we all know that the total fund return for the year is not going to be like we had in 2021. So that's kind of where we are with respect to the fund year to date. Any questions, discussion? Okay. And I think the last thing on the agenda is the FTX crypto.
Yeah, we're gonna have this discussion. I'm gonna put up a motion for us.
I believe you had mentioned that because of the sensitivity of this, you might want to go into closed session.
Yeah, we're gonna talk about this here. Oops, sorry. Wrong one. All right, sorry. Wait, let me go a little bit further on the page, sir. So you guys can read it. All right. Okay, now we should be good.
It's still global class action up.
The second one.
Oh, okay, I see it.
Yeah, okay, that's the right one.
I make a motion to close the meeting and that all records and votes to the extent permitted by law during the closed portion of this meeting be closed pursuant to section 610.021, subsection 1 of the Missouri Revised Statutes, for the purpose of having a confidential or privileged discussion with legal and contract matters.
Richardson, second.
Okay, I'll do roll call. Christina Bennett,
Yes.
Louis Cross,
Yes.
No. Wait a minute.
Sheila Goodwin. Okay. Donna Jones,
Yes.
Martel Mann,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
Doris Walker.
Yes.
So we do have 8, the motion carries. Just a few things. All right, we're good.
That was all that we had from ANCO for this meeting. So
I really thought you and Jeff gave an excellent presentation,
thank you.
and it wasn't a lot of paper.
All right. So that was all on the agenda.
Mhm.
Is it time to make our favorite motion of all?
I think you're up.
Hey, before we make a motion, happy holidays to everybody. But I make a motion to end this amazing investment meeting on today, December 15th, 2022.
Richardson second, and happy holidays to everybody.
Happy
Bye-bye.
holidays, everybody.
Holidays.
Take care.
Thank
All right.
you.
See you next
Bye.
year.
Everyone.
Okay, hey.
We'll see you out Monday, right? We'll see some of these people Monday,
Yeah,
right?
we'll see Monday. Yeah,
Yeah.
I guess everybody's in favor of adjournment.
Aye.
All right. Thank you all so much. Thank you, Gwelda.
Welcome.
Thank you.
Have fun.
Happy holidays, y'all.
Have fun.
Safe travels to those that are traveling.
All right.
Okay, good night.
Bye-bye.
Okay,
Good night, everybody.
good night.